Hello and welcome to BQ Prime. India's merchandise trade deficit rose to a record high of $31.5 billion for October. That's compared to $19.4 billion in September. Exports rose by 6.2% on an annual basis to 33.6 billion, while imports rose by 12.3% on an annual basis to $65 billion. To share more insights on today's trade data, we have with us Aditi Nayar, Chief Economist at ICRA. Aditi, thank you so much for taking time out for us today.
Thanks, Pallavi.
So, to begin with, while we did expect a slightly wider trade deficit for this month, the figures that have come in are a lot wider than expected. Of course, part of that seems to be because of the rise in imports led by gold and petroleum. Could you explain to us what are the reasons for these spikes?
Sure. So basically, when we had pegged in our deficit figure for the month of October, initially we were looking at a figure of about $22.8 billion. And between that and the deficit that has come in today, the increase is almost equally split from higher imports of gold, oil, and the balance items. So it's not only gold which has led to the higher than expected trade deficit, but yes, that is a significant factor. See, as far as gold is concerned, one thing we need to remember is that this time the festive season was a little later. And while the imports may have been preempted, possibly we would expect a much more muted number in the month of November. So that is something that could actually lead to some retracement from these record high trade deficit levels. Secondly, if you look at the oil import figures, so we basically back calculate a volume of the net oil imports, so which is imports less exports based on the published figures every month. And if you look at the H1 numbers, there is hardly any growth in the net oil import volumes as compared to H1 of last year. Now, after that, we have this big sequential jump which is coming in October. So it's not that the entire amount of the higher volume is simply for October. Possibly part of it is also relating to the fact that imports were kept on a tighter leash in the earlier months, maybe because of rising prices. So again, this is something that could normalize after the festive sort of bump up. Other imports as well would rise ahead of the pickup in demand. So these are some of the reasons why we think that the import number as a whole will sequentially moderate in November. However, so will the export number because we have a lot more of holidays in the month of November 2023 as compared to November 2022. And this is something that could lead to exports going back into a YOY contraction in the current month from the YOY growth that we saw in October. Overall, we should definitely average out these 2 months when looking at the pace of growth as compared to 2022.
All right. So, like you said, even exports are expected to see a little bit of a moderation from here on. So, so far for this month, we've actually seen a bit of a pickup in exports. This in a scenario where global growth has not been strong and is expected to remain weak in the next calendar year as well. So, on looking at the broader picture, what's the export scenario looking like? Can we expect the slowdown that we've seen in exports this year to sort of seep in next year as well?
A couple of things. October exports are showing a YOY growth because last year we had Diwali in October and factories were effectively shut for the holidays. So let's not look at that in isolation. Let's first look at what October, November together averages out, which we'll know in a month. Now, my best guess is that for a large part of this year, we are going to see exports showing a very weak growth at best because commodity prices are still lower than last year. That is a positive impact for margins, which is going away, but it's a negative impact for the export value numbers, and that will also normalize as we go into Q4. For next year, we should possibly be in a position where it's going to be a very similar trend between value and volume growth, unless commodity prices are very volatile going forward. So possibly for FY25, we should expect a low single-digit growth in overall exports. And for the next few months, we should probably expect the deeper contractions to sort of ease away and move into either a mild contraction or a slight growth in the remainder of this fiscal year.
Okay, so I do want to ask you that, from the last month to this month's figures, we have seen geopolitical tensions globally deteriorate once again. And so far, it's not had as much of a bearing on the Indian economy, or I'm guessing the exports segment. But going forward, do you see that as a factor that could pose additional headwinds to exports?
Specifically, Canada and Israel are not large trading partners for India, and India is not one of their largest trading partners either. So the direct impact of these issues was expected to be quite limited. The impact would be larger through the sentiment and the commodity price channel if the current Middle East tensions are to escalate going ahead. Then that is something that could definitely have a bigger impact through the commodity or the sentiment channel. But the direct impact is limited, which is relief as far as our own exports are concerned.
All right. And what's the outlook on the balance of payments front for this ongoing quarter? And do today's figures sort of have any bearing on what the aggregate figure for the quarter will be?
So for Q2, we are looking at a current account deficit of around $15 billion. That is something that is 13 to 15, I would say, for Q2. That's the September ending quarter, and that data we will have in about 45 days from the RBI. For the current quarter, I think we should at least wait for the October services numbers to come in and for the November merchandise numbers to come in. So we are expecting it obviously to be a wider quarter. That's typically the case. Q3 seasonally is a wider quarter for the current account deficit because imports really pick up for our festive season. So we expect that pattern to be followed this year as well. For the year as a whole, we are looking at a current account deficit of 1.8 to $2 billion, which is broadly in line with where we were before today's data was released.
Okay, so I do have one last question before we let you go. How do today's parameters stack up with other high frequency indicators? So far, what's it looking like? Would it be fair to say that while high frequency indicators seem to indicate that the Indian economy continues to remain resilient, headwinds going ahead are increasing? Is it a little bit of a mixed bag at this stage?
Yes, I would say so. Coming back to Q2, our GDP forecast, GDP growth forecast for Q2 is 7%. So a sequential slowdown from Q1, but higher than what the MPC had last projected. And for H2, we are basically saying that there are five major factors which are going to lead to growth possibly being below 5% in H2 FY24, which are the lingering impact of a weak and uneven monsoon on agri output and rural demand and sentiment. Second is the cumulative impact of the monetary tightening that we've seen over the last several quarters. The third is the easing benefit from lower commodity prices. The fourth is a high likelihood that after the front loading of capital expenditure by the central and the state governments, naturally there will be a slowdown in momentum as we get closer to the elections. And the fifth is that the external demand situation still remains tepid, and the geopolitical issues that you were just talking about aren't really helping matters in terms of overall sentiment and demand. So for FY24 as a whole, we're looking at a GDP growth of 6%. And within this, we're expecting H1 to be 7% and above, and H2 to come in at about 5%.
All right. Thank you so much. That was a most comprehensive roundup. Thank you for taking time out for us, Aditi.